Here we go. What is going on, everybody? I'm Jonathan Farrell.
I'm Daniel Garcia.
And we're the two mortgage guys. Today we want to talk about interest rates because they are falling and we're loving it right now. Basically, there's a lot of stuff that's been going on that's attributing to rates getting lower. And we have a lot of clients right now that are taking advantage of refinancing and lowering that rate from a 4 to 3.5 to 3.25. So, it's just basically like if you have a loan that is within the 4s right now, now is definitely the time to look at refinancing it.
Yeah, it's, this refi boom, everyone you see that time frame and everyone's wondering when it goes away, and it's still going.
Yeah.
And so if you haven't looked into doing a refi, even just to change rate, but if you have anything, you need some cash out, stop paying the high interest on your other installment loans or your credit cards or even your car at this point.
Right.
You're going to get a cheaper rate by rolling it into your house.
Right.
So,
and that's the other thing. If you take a look at it, debt consolidation, average American has about $15,000 worth of credit card debt. And so, credit card debt, you're paying anywhere sometimes 19 to, I think we saw Home Depot was like at 30%.
Yeah.
So, for every $1,000 that you're spending, that's $200 in interest that could be accruing. So, right. Especially when you take a look, an interest rate, APR for a conventional loan is at 3.69. That'll definitely help a lot of people out. Yeah. So, well, what's one thing we forgot? Our producers got us new mics. We didn't even mention that.
So you might be able to hear us better.
You might be able to.
Or
it might be worse. We don't know.
You might not want to hear us better.
I'm sorry, Daniel. I cut you off.
We have much clearer sound now thanks to new equipment in the booth.
New technology.
But no, it's one of the arguments I get of, when I talk about like a debt consolidation aspect of doing a refinance is someone say, well, but my car I'm only going to be paying on for 5 years. I don't want to turn that into a 30-year loan. Like, why would I do that? It's like, well, think about it. You're already paying your mortgage.
Yep.
Right? At probably a higher interest rate than it needs to be.
Right.
You're also paying your car at a separate interest rate and a higher payment. So the $250, $350, $450 a month that you're already paying in your car, plus your mortgage.
Right.
So if you have a $2,500 a month mortgage, you add your car payment to that. Now you're paying $2,900 a month in bills.
Right.
Just in those two bills. You refinance, take a potentially lower payment now on your mortgage.
Right.
And you get rid of your car payment. So now you have, and then you take that money that you're already used to paying in your car, put it as extra payment towards your mortgage, and you cut 10 years off your loan.
Right. Yeah, I think that's just the biggest thing, and that's ultimately we talk a lot about how we plan on educating people. This is not something that not a lot of people really talk about.
Right.
Because you take a look, just like you said, you might be eliminating $300-400 a month overall that you can then reapply that towards your mortgage. And now you're, instead of paying a 30-year mortgage, now it's down to 22 years. Now it's down to 20 years. So I think that's one of the things that, a lot of people don't really think about. They just think, oh, well, I have, I'm going to be redoing my mortgage term for another 30 years.
Right.
But if you do that, you're going to be saving a lot more interest overall.
Yeah.
It's going to be much better for you in the long term. Yep. And you could take that monthly savings that you were going to have and apply that towards paying down the mortgage, paying down the principal. So I think that's, and the other thing people keep talking to me about is, what do I do about maybe doing a 15-year?
Yeah.
I personally
don't.
Yeah, that's one of the things I think the company with all the rockets is really pushing right now is getting everybody into a 15-year. But ultimately, the one thing that I will tell you is I would take a look more at the comfortability factor, right?
Yeah.
So 15-year, yes, it is going to have a slightly lower rate than a 30-year at this point. But ultimately, if you were to take these different steps and maybe pay off some of the debt with your existing mortgage, put that into a 30-year, and then apply that monthly savings that you were going to have anyway to paying down your mortgage, it's basically going to be the same as if you were doing a 30-year.
Right.
And then you might have one of those months where, hey, you know what, I need that extra $300-$400 a month to do what I need to do.
Right.
Now it's available. Now you don't have to make that larger payment. You know,
Right.
now you have that 30-year payment where it's much lower, much more manageable. And I think that's a lot, one of the things that people don't really think about. Everybody asks me, okay, what about a 15-year term? And I mean, I'll give them the option, but ultimately, sometimes 30 years is the much better option overall.
Yeah, it depends on what situation you're in, where you want to be. But generally speaking, having that flexibility to to take, rather than being on the hook for that extra extra $1,200 a month that a 15-year would be on a normal loan. There's might be one month where car breaks down.
Yep.
Right. Or opportunity comes up for a vacation.
Yep.
And now
oh man, I want an opportunity for a vacation.
like there's again, I'm all for kind of pushing yourself into a more responsible situation, and sometimes people need help with that extra pressure and discipline of
right.
Not having that flexibility.
Right.
And they have to have that pressure so that they don't get wasteful with their money. So doing that. But at the end of the day, like taking a 30, knowing you have the cushion of the lower payment so you don't risk having a mortgage late that now kills your credit. So you don't have, that issue pop up, but you have the option to put the extra principal towards. You're going to end up saving just about as much as you would if you were to do a standard 15.
Exactly.
Just by making the 15-year payment on a 30-year loan.
Right.
So
the other thing that people don't really talk about is, you make 12 payments a year, right? So you make 12 payments a year, but if you were to make an additional payment a year, so a 13th payment,
yep.
that immediately will cut down about 7 years on your mortgage.
Yeah.
Right? So you take that extra, let's just say your mortgage payment's $2,000, you take that extra payment, make that towards just principal, yep. and now you're knocking off a significant portion of your loan term anyway.
Right.
So, again, you don't have to have a 15-year mortgage to save money.
Right.
There's a lot more ways of going about it, and you can do it when it's comfortable, right? So, just like we talked about, 15-year is great for some people. It's not for everybody, but when you're asking and taking a look at the difference between that, there's other ways of saving on your mortgage, cutting down that time rather than having to go directly into a 15-year loan.
Right.
So, it's just something that, I don't even think a lot of people really think about too. Just being able to go ahead and do that, make that additional payment per year. Now you're knocking 7-8 years off your mortgage loan anyway.
Right.
So now the other thing, it's kind of funny because, before we got into this mortgage insurance, right?
Yeah.
So a lot of people right now are like, okay, I have a good interest rate, but I also have mortgage insurance.
Mm-hmm.
And so there's other ways that we could take advantage of today's current interest rates mm-hmm. and also taking off mortgage insurance.
Right.
The biggest thing is people don't think about prepaying their mortgage insurance up front, mm-hmm. right? So you might have an FHA loan where you have a 3.65% interest rate.
Yeah.
Conventional interest rate is going to be 3.5, 3.65 anyway. But what we could look at doing is prepaying your mortgage insurance up front with a conventional loan.
Right.
And now you have a couple $100 less that you have to make per month.
Right.
Yes, it does add a little bit. Typically, it could be an extra $8,000-$9,000. But over the course of 3 years, mm-hmm. I mean, that's $300 a month that you'll pay that back.
Right.
And then you won't have mortgage insurance for the entire life of your loan.
Right.
So, again, too, I think that's another thing that people, if you have mortgage insurance now and maybe you don't have the 20% equity, we could take a look at prepaying that mortgage insurance, which is going to have a significant monthly savings for you
yep.
and get you out of that completely.
Well, so. And if you did, for whatever reason, we do many where you start off in an FHA loan, current situations at the time, whatever it is, and now things have improved. You do have some equity. Maybe you're still not at the full 20%, but you have some equity to do. Being able to refinance it into a conventional is going to have most likely a lower mortgage insurance factor than what the FHA standard is. there's little advantages like that we don't always think about. We just look at the interest rate,
Mhm.
and you forget that
There's
I
other
could give you
factors.
the same interest rate, yet still save you money each month.
Right.
You don't know until you look at those factors, and that's what our job is.
Right. Yeah, and again, you touched on that. I think that's something that's super important is just taking advantage of little tricks of the trade,
Mhm.
right? The reason why people would go to us versus going to their standard bank is you don't fit into the cookie cutter mold.
Right.
You're not going to be able to get the loan.
Well, you don't get that extra thinking and extra strategy by clicking through
Online.
a website.
Right. Ultimately, that's the biggest thing when we talk with specific people. Like your situation might be different than Joe Schmo's. You might have a different credit score. You might have different equity. You might have a different loan program.
Right.
There's certain things that we're going to take a look at that standard bank isn't going to be able to do or be able to match, right?
Or you just care to take the time to do.
Exactly. Yeah, and I think that's the biggest thing. Like, for instance, like I have a client right now specifically. We are talking about doing a refinance and prepaying that upfront MI. It's going to save her $250 a month.
Yeah.
So, and then in addition to that, she's at a 4.5% interest rate.
Jeez.
So we're going to be able to drop that significantly
Mhm.
and eliminate the mortgage insurance for her.
Yep.
And so, just little different things, little tricks, that we could do to help save people a lot of money. And ultimately, like that will be a big help.
Mhm.
So anyway, I think that's, the biggest thing. If you are in the market looking to refinance, give us a call because there's a lot of different things that we could do out to help eliminate either your current monthly debt or lower your monthly payment. We're always available. James is going to flash the number down below every time I do that. He does it, so I love it. So we're going to flash the number down below.
If I go like this,
yeah,
the number will pop up.
A number will pop
just
up,
just
like that.
Huh. That's
Yeah.
pretty cool. So
there's a number that
right
is
there.
popping up right now.
Boom. That's the number they call.
Right. From the Two Mortgage Guys studios in the beautiful Temecula, California, I'm Jonathan Farrell.
I'm Daniel Garcia.
And we're the
Two Mortgage Guys.